The economic numbers have been much kinder to the federal government than the opinion polls. It means that the Reserve Bank is unlikely to raise interest rates during the election campaign, as it did to the Howard government 3 years ago. Last week's benign inflation results means that the Reserve Bank board is expected to sit on the sidelines and keep official interest rates where they are. Here's Philip Lasker.
If the experts are right, Reserve Bank Governor Glenn Stevens will find tomorrow's Reserve Bank board meeting an enjoyable one.
The decisions I like are the ones that are really obvious. Unfortunately, I haven't had all that many of those confront me during the past nearly 4 years.
Well, tomorrow's decision is one of those rare sure things. The cash rate's expected to stay at 4.5% for a fourth month.
I think it's fairly clear that the Reserve Bank's not going to do anything tomorrow. It's a combination of the world economy, people being concerned about Europe, equity markets being a bit weak, and particularly the retail sector is, I think, quite weak globally and also locally.
The weak retail sector, where cautious consumers are reluctant to pay full price, is the main reason for Australia's benign inflation landscape. Last week's weaker-than-expected CPI result has been backed up by today's TD Securities inflation gauge, which rose 0.1% in July. The increases have been getting smaller since May. Also wilting is the housing sector. The withdrawal of stimulus and higher interest rates are starting to bite. House prices are softening, and sales of newly built homes fell for the second straight month, down more than 5% in June after a 6% slump the previous month.
Well, at this point in time, we have close to 200,000 dwellings short of where we need to be to meet the demands of the population. That shortage is primarily concentrated in New South Wales, to a lesser extent also in Queensland and in Western Australia.
But Western Australia has its mining boom to nourish the state and national economies, and the manufacturing sector is staging a comeback despite the higher interest rates and Australian dollar. Australia's performance of manufacturing index rose 1.5 points in July, remaining above 50, which means the sector is expanding thanks to an encouraging mix of rising new orders, deliveries and production. It's partly why most analysts think the jobs market will remain tight and capacity pressures will re-emerge, along with the likelihood of higher interest rates.
The mining sector, the manufacturing, particularly the construction sector and finance is now doing better. Business investment is starting to come back, and eventually you're going to see house prices continue to go up, unemployment to go down, and so it's just a matter of timing as to when you start to increase rates.
By contrast, international data has been on the weak side. There was a marked slowdown in growth in the second quarter data out of the United States, while today's numbers out of China showed the manufacturing sector cooled further in July. But the weakness offshore isn't enough to change interest rate perceptions for Australia. It's just a question of whether the next rate rise is next month or next year.